Merry Christmas, little fella.
It's Santa Claus. And it's Elf.
We're not gonna hurt you.
No. Got some nice presents for you.
Welcome back to Strongman Personal Finance, everybody. In today's video, we're going to look at UPSTART, or as I like to call it, UPSHART. Now, apparently during the pandemic, UPSTART was all the rage. It's disruptive. It's the future, bro. It's going to revolutionize how we assess the creditworthiness of borrowers of loans. Now, keep this in context, ladies and gentlemen. Back during the clown market, everybody was getting stimmy checks and money and blah, 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 blah. Money was cheap. And when money's cheap, people borrow freaking money. But what happens is the economy goes in cycles. Sometimes we have booms and sometimes we have busts. And now it looks like we're entering into a recession. And if you think about it, interest rates are going up. People are losing their jobs. There's uncertainty in the economy. There's inflation. We have so many freaking issues. Hold on a second. Let me fix my audio. Okay, now it should be good. We have so many issues in the economy. And software or companies that facilitate the origination of loans to consumers are probably going to be hammered. Because if you think about it, who's borrowing money now when mortgages are like 7% and auto loans are God knows where? Holy freaking crap, okay? So let's go ahead and see what's happened to old UPSTART. And then we'll talk a little bit about the business. And then we'll go look at the financials, okay? So here's UPSTART. They just had their Q3 earnings. And they got absolutely freaking wrecked. In the past week, they're down 16%. We back out the past month, down 21%. Back out the last 3 months, 40%. Well, last year, down 94.94%. Holy freaking crap, okay? Let's go ahead and check out their website. So here's their website. And if you go and look for lenders, because their customer is really the lenders. They partner with banks to help facilitate loans. The bank needs customers. UPSTART provides their AI software that provides a new and a disruptive way to analyze people's creditworthiness. And then they connect the banks to the consumer. And the banks pay UPSTART through trailing service fees because UPSTART can administer the loans. And they get some kind of payment for connecting the borrower to the bank. That's what UPSTART's all about. So the first question you have to ask yourself is the AI software actually what it's baked up to be? Is it actually something that improves, underwriters and people analyzing loans? Does it actually improve their ability to judge who's going to default on their loans, who's most likely to default, and who's not? I don't freaking know. Do you understand UPSTART's AI software? Do you have experience in underwriting? I don't. I'm a freaking accountant, okay? But when it comes to companies like this, people don't care about, some of the concerns. What is their customer concentration? The last I checked, they have a very, very concentrated position. They have one customer at some random bank I never heard of that provides the vast majority of their revenues. Have you considered that risk? There's so many risks involved with this company on top of the terrible economy, which is hurting lending massively and which is going to hurt their fees and their profits massively. If you haven't considered that because you just got swept into the whole, oh, but it's disruptive and it's the future, bro. Well, you're a freaking clown, okay? Now, if we go look at UPSTART's financials, right? Let's go look at the annual report, annual revenue, excuse me. So we can see they've had steady freaking revenue by revenue growth from 2017 all the way to 2021. And even during the pandemic, even after the pandemic is abated, they still have revenue growth. But you can see the year-over-year revenue growth is significantly slowing down, and it's dropped from the last quarter. So their revenue is probably going to continue to decline because banks don't want to lend as often because of the heightened risks in the economy. So the question is, can this freaking company survive? Well, let's go look at the financial statements, and I'm just going to give you my opinion on what they are. Okay, maybe you think it's disruptive, maybe you think it's the future. I don't really care. I just like looking at the financials. Okay, so how they have it set up, they actually have it set up a different way than normal. Usually the latest one is on the left, at least with other companies, but whatever. Okay, so on the right side is their most recent financial data. So we can see their cash on the books has gone down by roughly $300 million. Their restricted cash has gone down by 50 million. Their loans, so they have loan assets. And here's the thing, okay? When I was skimming through this 10K or 10Q, I noticed that, what they do is like they help connect banks to people that want to borrow money. And the AI software helps the banks determine the creditworthiness of the borrower. But it seems like since the banks aren't, issuing as many loans, it seems to me like Upstart is now taking more of these loans onto their books. And you can see the massive growth in loans, which are on here at fair value. And you have to ask yourself, how are they calculating fair value? Well, they're probably just pulling it out of their butts, to be honest, because a loan's fair value is your best assumption of your, its future cash flows discounted back to the present. How they determine that, I don't know. Okay. But you look at this, there's a lot of judgment is what I'm saying. You can see that the loans on the balance sheet have massively expanded. So cash is down. Loans are up very, very significantly because they're putting a lot more loans on their balance sheet. Think about it. If they can just pass off a loan to somebody else, no harm, no foul. You collect a fee, you administer the loan, you get all the fees from the bank. That's great. Now they're taking a lot more risk onto their balance sheet. Something to be careful of. PP&E has gone up. Leases have gone down. Non-marketable equity securities doesn't matter. No change in goodwill. Intangible assets down a little bit. So overall, their total assets have increased by roughly $100 million. Okay. There is a pretty big decline in cash, but when we go in the statement of cash flows, we'll see why. All right. Debts, accounts payable up a little bit, payable to investors down a little bit. Borrowings, their borrowings are up by $200 million. Let's see, accrued expenses down and operating leases. So overall, their total liabilities have increased by roughly $200 million. So it looks like they've had a decline in the book value of the company. And we're probably going to see that they had a loss. Okay. Oh, and they did. Now, how do I know they had a loss? You can always go to stock or retained earnings, and you can see if retained earnings goes down. Retained earnings as of December 31st, 2021 was 66 million. Now retained earnings is 12 million. And like I said, there's multiple ways you can reduce retained earnings. You can do a constructive retirement of shares, dividends reduce retained earnings. But generally, profit or loss is the biggest player in whether retained earnings, the company's accumulated profit or loss since its inception, not including dividends and stuff. If that goes down, the company probably had a loss, okay, which they did. And let's see about shares. Did they issue shares? Well, it looks like the shares outstanding have decreased. Their share count outstanding has gone down. I don't know why that is. We'll go look. They're buying back shares, bro. So overall, their balance sheet, we compare current assets to current liabilities. I don't know what these borrowings are. I don't know if they're short-term debt or long-term debt, which is annoying because they don't break it out. It's with it's below accrued expense or above accrued expenses. So that might be short-term debt. But overall, their balance sheet looks okay. They have more assets than liabilities. The biggest concern to me is they're having a massive increase in the amount of loans on their books. And by reading the 10Q, by skimming it over, they're doing that because they're having a harder time connecting the banks to the consumers and then being able to just, pass that loan off once they connect them. So they're taking on a lot more risk on their books themselves. And you got to ask yourself, okay, they're measuring it at fair value. How are they calculating that? Can you trust the people that they're lending to, especially in this economy? Is the AI software going to screw the investors over because maybe it has a fundamental flaw that we don't know about? I don't know. Okay. Let's go look at the income statement. Okay. So it looks like they had Revenue from fees has gone down. That's the fees that are paid to them by the banks to help facilitate the loans. Fees are down. Interest income, they actually had negative. Well, they didn't have negative interest income. They had fair value adjustments. So it looks like here that they're writing down some of their loans. Their loans are worth less. The expected future cash flows of the loans are less than what they were from the prior quarter. Why? Because people are probably not able to pay their loans as much because our economy is going to crap. Okay. Or at least that's what people say. So the revenue overall is down pretty significantly if you compare it on a quarterly basis. But if you look at that over 9 months, it is up. But that's probably because, that was probably factoring in before the interest rate hikes. Okay. The interest rate hikes are going to hurt this company significantly because it's going to hurt the economy. People are not going to want to borrow money as much. And the current people that have the loans, if they lose their job, they could default. Okay. Sales and marketing expenses down. Customer operations expenses up a little bit. Engineering and product development has gone up pretty significantly, almost doubled. General and admin has gone up. So overall, their operating expenses have gone up while their revenue has dropped pretty significantly year over year. Okay. So they now have a loss from operations. And roughly half of that was from fair value adjustments, it looks like, write downs of loans. And that may be covered up by interest income. The write downs could be greater because here they're combining interest income and the fair value adjustments of the loans. So I don't know. But their overall operating loss is negative 35%. Oh, yeah. Okay, let's go look at the statement of cash flows. Okay, so we can see they had net cash used in operating activities. They burned in their operations $421 million. Now, let's see if there's any huge differences between the 9 months ended 2021 and 2022. So we can see there's a change in fair value of financial instruments. So here they're subtracting it because it looks like this is in 2021 because the fair value went up. The fair value in the prior year for those 9 months went up. So if you have a non-cash gain on your income statement, you have to subtract it on the statement of cash flows. If you have a write down, you have to add it back. So in the last 9 months of 2022, they have had negative fair value adjustments of the loans on their books of $71 million. So they're writing down those loans, and that could get worse and worse and worse and worse. Next line, stock-based compensation. Oh, it's gone up. What percentage of their revenue for the last 9 months is stock-based compensation? Let's go see. Negative 92 divided by 698. So roughly 13% of their revenue is being eaten up by stock-based compensation. Okay. Dilution, bro. It's a feature, bro. All right. Gain on loan servicing arrangement. Okay, so it looks like they had a gain there because they subtracted it. Depreciation, amortization, nothing crazy there. Let's see. Purchase of loans held for sale. So it looks like there's a huge difference here. So this looks like the big difference here, where they're purchasing loans held for sale. So when it says held for sale, it looks like their intention is they're going to buy these loans and then they're going to try to shuffle them off to somebody else. At least that's what they're saying. The question is, are they going to be able to do that? So this right here, this purchase of loans held for sale, is the reason they had negative operating cash flow by and far between. Okay. Massive freaking difference there. And you can see they are selling the loans held for sale right here. $854 million, but they purchased way more in the last 9 months. So they may have trouble selling these loans, getting them off their books because they're taking on a lot of risk. So overall, Massive cash burn, basically because they're purchasing these loans held for sale. Maybe they can get them off their books. Maybe they can't. I don't know. Let's see. Obviously, they have negative free cash flow, investing activities, no major changes there. And financing. Proceeds from borrowings. Okay. It looks like they borrowed $430 million in the last 9 months. And they paid back, roughly $209 million. So their net long-term borrowings have increased by, looks like $200 million based on this. And it looks like they did buy back stock. So apparently they've spent $150 million in the last 9 months buying back stock. So overall, if you don't understand the AI software and you don't understand, you don't know how long this high interest rate environment is going to be, and you don't understand how they do fair value, how they measure the value of these loans, and you're concerned that they're putting all these loans on their balance sheet, because that's a pretty significant increase. And if you're concerned about the massive operating cash burn, mostly from that purchase of loans held for sale, I don't know what to tell you. You let me know. Let's see. Yo, VT Maiti. I'm Paul, and I bought Upstart. I just wrote some puts against Upstart. $1. That intro is a masterpiece. Yes, it is. Who the heck is this guy I live with? I don't know why I have a shirt on. It's a good question. Let's see. I think my mic has worked itself out. I think I fixed it. StreamYard defaulted. Yes. I should have fixed that. I'm an idiot. Andrew, he's in the house. Andrew Maynard, go check him out. He's my fellow certified CPA. Are you an Upstart, bro? I bet Kathy Wood bought this, didn't she? Upstart, my option. Let's see. Oh, no. Amateur bankers lost all my money. Who would have thunk it? Yeah, this is going to be a real test of Upstart's AI model. Because if there's more defaults than they expected and their AI was actually bad. Woo, boy. The Motley Fool is the biggest grift of all. Every single record they make is clown companies like this. Yeah, most people are clowns, okay? It's the future. Buy it. Lost so much money trusting them when I first started investing. I put my life savings in Bitcoin. No, you didn't. Like the video if you haven't already. Strong man on next Mr. Beast. I'll never be like Mr. Beast, because if I made all the money he did, I would not spend it. That would go straight into VT. I only get loads from Lehman Brothers. When is your video about FTX? Are you prepared to stream about YouTuber promoting it? Oh, it's coming up. Me and Andre are going to have a reckoning pretty soon. All right, guys. Thanks for all your comments. I can't get to them all because I have to do a video very shortly, but I am not touching this freaking crap. Okay? Let's do a little foo-foo. Now let's do an Everything Money outro, and you guys have a wonderful day. Cheers!
Also quick, smart, and disciplined.
When you increase liabilities, it's a debit the liabilities. Let's say $10. Cash?
Writing off the top of his head, it was incredible. I'm just sometimes sitting there in awe.
Oh, zero margin. Of course that makes sense. Of course it's going to be zero.
I'm probably smarter than you, so it's okay.
Jeremy, you talk about transparency? When did you let everybody know you're being paid every month by whatever stock was trying to have you pump and dump? Not going to lie, guys. He's a lot more value-oriented than he portrays on the channel.
I am very